right? So give you annual number. Let's see here. In case of straight line method, the depreciation of truck would be cost minus residual value. Cost 41,000, residual value is 1,000 divided by number of year 5. Answer would be 8,000. So this 8,000 would be your annual depreciation. Annual depreciation, right? So in this question, you have two lives given. Estimated useful life, 5 year, or it can run up to 100,000 miles. So which year, which life you need to take? Life in years. Okay, everyone. Harry, understand? Marilyn?
Yeah.
Hunjin Kim? Who is iPhone 13 Pro?
Yes.
Who is this iPhone 13 Pro? Okay. Okay, Deon. Okay, Deon. Okay, now understand?
Yes, sir.
Okay, let's move forward. Now, on every year, 8,000 will go to income statement, right? And 8,000 will go to accumulated depreciation in balance sheet. So if you recall our previous discussion, I told you the treatment of depreciation, and then I also told you over there, we will be discussing this extensively, but the entries remain the same. So here we go. So remember, the recording entry would be depreciation expense to accumulated depreciation, right? Depreciation expense to accumulated depreciation, 8,000, 8,000. So if you want to see that what will happen after 5 years, so you see here, the depreciation is 8,000, so 41,000 minus 8,000, answer is 33,000. And now 33,000 minus 8,000, answer is 25,000. 25,000 minus 8,000, answer is 17,000. 17,000 minus 8,000, answer is 900,000. 9,000. 9,000 minus 8,000, answer is, so this is the accumulated depreciation, which is equal to the cost. So depreciable cost. What is the formula for depreciable cost? Cost minus salvage value. Cost minus residual value. 40,000. And this is the salvage value. So remember, at the end of the life, the value of the asset equal to salvage value. So that can be asked in the objective part, true, false, or maybe MCQs. That at the end of the life period. Sorry about my writing. At the end of the life period, the book value of the asset is equal to salvage value, SV, or scrap value, or RV, residual value, right? So as the assets are used in the operations, its depreciation, accumulated depreciation start increasing, its book value start decreasing. What is the book value? Cost price minus accumulated depreciation, right? So accumulated depreciation start rising while book value start decreasing up to residual value. We just see that in our previous slide, right? So if you don't understand that, here we go. Let me clear the mess here. So whenever the life is increasing, cumulative depreciation start increasing. 8,000, 16,000, 24,000, 32,000, 40,000, and book value started decreasing. 41,000, 33,000, 25,000, 17,000, 9,000, at the end equal to residual value. Right? If you understand, answer this question. You have 5 minutes. Take a picture, and I'm making a breakout room. Solve it. Dion, join the breakout room. Harry, Nam, join the breakout room. Okay, those who are watching online, I'm pausing the video for 5 minutes and then I'm going to be resuming that. Okay, class. So let's talk about the answer here. I have received your answer file. Here we go. So a FedEx sorting machine that cost $10,000 with a useful life of 5 years and a residual value of $2,000 was purchased on January 1st. So remember the dates as well. Sometimes you need to calculate partial depreciation. We will see in our coming slides as well. But remember, the SL or straight line method is going to give you annual depreciation. So what is the depreciation? So 10,000 minus 20,000. Divided by useful life, 5 years. So what is your per year depreciation? 1,600. And now, any question regarding this straight line method? Marilyn, Nam, Ella, Hunjin Kim, Harry, all clear?
No question.
No question, sir.
Okay, so let's see our second method, which is units of production method. Remember, the entries, the journal entries are the same. Just how we calculate the numbers, that differs. So unit of production in which useful life is given in terms of units or some other methods. So in which fixed amount of depreciation is assigned to each unit of output produced by the assets. So it means depreciation is not based on years, it is based on output, how much this can produce. So in this case, the depreciable cost is equal to, simple, the cost, it should be divided by not the life in years, but life in units, right? And then if you want to find out the depreciation per unit, depreciation multiplied by the number of units the asset has used. So per unit depreciation expense is multiplied by the number of units produced each period. So that is very easy to calculate. How? Here we go. So we know that the truck is going to run for 100,000 miles. So how much is the depreciation per mile? Simple. So what is the depreciable cost? Cost minus residual value divided by life. Life in terms of units. In straight line method, life in terms of years. In unit of production method, life in terms of units. Simple. So 41,000 minus 1,000 divided by 100,000. 0.4 per mile. So per mile depreciation is 0.40. So the illustration says in first year the driver drove 20,000 miles. Second year 30,000, 25,000 third year, fourth year 15,000 and 10,000 during fifth year. So what is the annual depreciation? Simple. 0.4 is a rate. So you multiply 0.4 with the units. Simple. So 20,000 run, 20,000 mile. So per mile is 8,000. So that is the cumulative depreciation, and book value is equal to 41,000 minus 8,000, 23,000. Okay. Second year it run 30,000 miles. So 30,000 multiplied by 0.4, answer is 12,000. Right? 12,000 are added to the 8,000, answer is 20,000. And less 12,000 from the 33,000, answer would be 21,000. Similarly, so at the end, we are left with the value of residual value. That's it. So entries are the same, just figures, yearly expense is different. So you see something extraordinary here, and that is yearly expense in unit of production is different, not even 8,000, 12,000, then 10,000, 6,000, 4,000, which means the more you drove, the more the driver drove, the more the depreciation is. Right? So it's not like 8,000, 8,000, 8,000, 8,000 evenly on every year. So what is the entry? Simple. The entry of the depreciation, entry was the same, just amount of figures here going to be different. Simple. Depreciation expense to cumulative depreciation for first year 8,000, second year 12,000, here going to be 12,000, third year going to be 10,000. This is like that. Fifth year going to be 4,000. Now, measure and record depreciation on plant assets. The last one is double declining method. How much time we have? Okay, we still have time. So, double declining method, as its name implies, double. So it means it is somehow to do with 2 times. So double declining method is twice of the straight line method, but there is a small trick here. So in straight line method, if we go back here, I didn't explain you over there purposely this column, the rate, right? So this rate, how we calculated that? 1, where I can write 1 by n.